For Wall Street Media, this is Irene. I'm here with Doc, and we'll help you make money in the stock market with the information you can't find anywhere else.
That's the truth, isn't it, young lady? Right?
Yeah.
Hopefully you made 80% in Las Vegas Sands. I've only been telling you about it for 3 days. Hats off to Kuna 100 from StockTwits.com. If you didn't make 80% today, you ought to tune in to what the hell else we're doing. We added Netflix today. They go with the world's greatest company who make everybody's life on Earth better, Microsoft. And Netflix will be built into Microsoft's Xbox Live community beginning on November 19th. So I expect them to make quite a bit. Bought them early this morning. Internet Brands, INET, super cash-rich company. I think German, that was from B. Riley's Cash-Rich Stocks Conference, right? And they're super one, and they're low. Bought them today. Activision, I've been telling you about. All the kids your age, right? Got to have the latest video games. They've got the newest version of World of Warcraft, 11 million subscribers.
Wow.
Out. That's coming, right? The Rockstar, the latest plug-in for Rockstar, right?
That.
I knew you would. I knew you would. Right? That just came out, right? And I think they're going to sell like crazy. I've been loading up on them. And that's the small picture, right? And the big picture stuff, the macro stuff, we have a bright, ethical, wonderfully decent guy, Rich Gordon. And what's he have to say?
Rich Gordon, fixed income market strategist of Wachovia, ticker WB, discusses the historic destruction and shareholder wealth downturn that has taken place over the past 6 weeks, which he says closely resembles the 1973-1975 downturn. And he takes a deeper look into the credit crisis.
The destruction in shareholder wealth over the past 6 weeks has been historic. U.S. markets have lost 32%, and the rest of the world has done even worse. All investors' eyes are glued firmly to the stock screens each day because any risk assets that actually have enough liquidity to trade have been correlated with stock prices. And in the second half of September and October, that price direction has been completely bearish. Here are a few things to keep in mind about the credit crisis of 2007-2008. First, markets eventually recover from even the sharpest downturns. It takes a combination of innovative thought, balance sheet repair, and as we first saw during the New Deal, a lot of government assistance financed by debt and paid for by future generations. So it's no surprise that there's already been over $1 trillion of federal assistance for the banking sector announced, and I expect there'll be other injections into the housing and auto industries, as well as additional fiscal stimulus for the consumers. Second, in their last weekly commentary, our economics group makes several excellent points. Recessions tend to clear out the excesses built up in expansions, and the greatest excesses in the recent expansion were in finance and housing. Both have seen the deepest correction so far, and rightly so. While other businesses might have benefited from cheap credit and abundant liquidity in this last expansion, most companies weren't overly aggressive in making fixed investments or in hiring. As a result, the downside risks to the real economy may be less than a lot of people think. Investment-grade corporate bonds are an example of a sector that may be priced to an economic scenario that's just too severe. Look at how much wider spreads are now compared to the previous historical wides. The second point our economics group makes is that the current recession will likely be along the lines of the 1973 through 75 downturn rather than the milder, more recent recessions that lasted for 9 months and saw a peak-to-trough GDP decline of a maximum of 1.3%. In the 1973 to 75 downturn, real GDP declined by 3.1% from peak to trough, and it lasted for 19 months. Our economics department's current forecast is for 3 quarters of declines in real GDP and 2 years of declines in domestic demand. Assuming that we've sized the economic downturn correctly, we can then make some educated guesses as to how all this is going to play out. Our analysis presupposes several things. First, the equity markets will probably provide a leading indicator of a trend towards the eventual normalization of the credit markets. We think this is a reasonable assumption because the liquidity in the equity markets has been superior to even the highest grade fixed income credit markets. Over the course of 2009, we think that dislocations between fixed income and equities will eventually be resolved by prices in the fixed income risk sectors converging towards relative equity valuations rather than vice versa. And second, while some of the things we've seen in the financial markets over the course of the credit crisis are unprecedented, over the past 40 years, we have repeatedly seen periods of over-aggressive lending, excessive risk-taking activities that led to asset bubbles, and the economic contractions that inevitably follow. Therefore, we think it's reasonable to think that analyzing the data during these periods will provide information and color on our current situation. In the table, we show how the stock market reacted in the recessions of 73-75, 81-82, 1991 to 92, and 2001 to 2002, as well as the analysis for the stock market crash of 1987. We elected not to draw a quantitative historical comparison to the Great Depression of the 1930s. There's a far greater body of economic understanding and monetary controls in place right now, so it's unlikely that the recovery timeframes in particular would be very relevant. While some pundits and journalists recently have suggested that we're again heading towards Depression-era conditions, it's important to keep an accurate historical perspective, especially in this point. During the Great Depression, the unemployment rate peaked at almost 25%. The current unemployment rate is 6.1%, and our economics group forecasts a peak of 8% during this downturn.
Hey, that's from the horse's mouth. That's a smart, decent, ethical guy telling you what he thinks is the big picture. I've got one last one. Another smart, decent, ethical guy who I really like is my buddy Eric Zeck, and he's the president of Real Good Solar. It's RSOL. Now, guys, we told you Las Vegas Sands. I don't know what else I have to do. Play the drums or the bongos or something on here to get your attention. They're up 80% today. Activision, I've been telling you. Aspen Bio, I've been telling you. I told you about Capteris, my other buddy, Dave. And they were bought out. You picked up 30, 40%, depending on when you bought into them and from when I started to tell you. Real Good Solar. Eric Zeck is a pal and super smart, right? These guys, they made an acquisition 2 weeks ago of a solar company. They paid less for it than the company's going to make in revenues for the year, okay? And, you know, that's the hottest sector, right, is green tech, right? There's green tech conferences, clean tech we did from London last week, right?
Right.
And they're making smart acquisitions. He's a smart guy. I own some of it. Hopefully you'll own some of it. Hopefully you'll check out stocktwits.com and get some great ideas there. Kuna 100's been on fire, man. Yeah, he's going to put us into our own Wall Street Media private jet soon enough. And if you want to watch all of Rich Gordon's video, you can also do that for free, and that's at wsw.com/webcast/WAV, and you can see the whole thing there. And he's a wonderful, smart guy.
All right. We are here every day at Wall Street Media. You can find us directly at wsmco.com. Thanks.